Have you ever wondered how traders navigate the turbulent waters of financial markets? Today, we delve into the world of Bollinger Bands, a tool that helps traders ride the waves of volatility. Bollinger Bands are a volatility indicator and trading tool created by John Bollinger in the early 1980s. They've since become a popular tool for traders navigating the financial markets. But what exactly are Bollinger Bands, and how do they work? Picture three lines running parallel to each other on a chart. The middle line is a simple moving average, which is the sum of the closing prices of a stock over a certain number of periods divided by that number of periods. Typically, traders use a 20-period moving average, but this can be adjusted based on preference. The upper and lower bands, which make up the bands in Bollinger Bands, are calculated using standard deviation. Standard deviation is a statistical measure that delivers a standard or average amount by which individual data points deviate from the mean. In the case of Bollinger Bands, the upper band is calculated by adding 2 standard deviations to the moving average, and the lower band is calculated by subtracting 2 standard deviations from the moving average. Why 2 standard deviations, you ask? Well, this is because 2 standard deviations account for approximately 95% of the data points if the data follows a normal distribution. This allows the bands to encompass the majority of the price action, giving traders a comprehensive view of the market volatility. Now, how does a trader use Bollinger Bands? When the bands contract, this indicates low volatility. It's akin to the calm before the storm. Traders anticipate that volatility will soon increase and a substantial price move may be on the horizon. On the flip side, when the bands expand, this indicates high volatility. Prices are moving aggressively, and this is often where traders look to take profits or enter new positions. Bollinger Bands also provide a relative definition of high and low prices. If the price touches the upper band, it could be seen as overbought, and it may be a good time to sell. If the price touches the lower band, it could be seen as oversold, and it may be a good time to buy. However, remember that while Bollinger Bands can help identify when to buy and sell, they should not be used in isolation. They are most effective when used in conjunction with other technical indicators. To summarize, Bollinger Bands are a volatility indicator consisting of a moving average and 2 standard deviation lines. They help traders to gauge volatility and potentially identify buy and sell signals. However, they should always be used as part of a broader trading strategy. Bollinger Bands are like navigational aids in the vast ocean of financial markets. They won't predict the future, but they can help you understand the current market conditions and plan your course accordingly. So the next time you dive into the financial markets, consider using Bollinger Bands to guide your journey.